Why was Wells Fargo CEO John Stumpf grilled by Congress? Imagine running a bank where employees feel pressured to meet impossible sales goals, even if it means breaking the law. That's what happened at Wells Fargo, and it led to a big scandal. John Stumpf, who was the chief executive officer of Wells Fargo at the time, was called to testify before Congress because of this mess. The scandal involved over 2 million fake accounts and credit cards created without customers knowing. These accounts were opened between 2011 and 2015, all driven by a culture that pushed employees to sell as many products as possible. The trouble came to light in 2016 when regulators, including the Consumer Financial Protection Bureau and the Office of the Comptroller of the Currency, fined Wells Fargo $185 million. The bank admitted that about 5,300 employees had been involved in creating these unauthorized accounts. Employees did this to earn bonuses and avoid penalties, which shows how the incentive programs encouraged unethical behavior. The scandal hurt Wells Fargo's reputation because it was known for trust and good service, but this incident made customers question whether they could rely on the bank. Congress called Stumpf to hold him responsible for not stopping the misconduct earlier. Lawmakers wanted to understand how the company's culture and sales targets led to such widespread cheating. They asked why the bank's internal controls failed to catch the fake accounts sooner. Stumpf was questioned about the oversight mechanisms in place and why the unethical practices continued for years. Many lawmakers criticized the leadership for putting profits ahead of customer welfare and ethics. As a result of the hearings, Stumpf had to give up tens of millions of dollars in pay and eventually stepped down as CEO. The scandal also led Wells Fargo to end its aggressive sales goals program. This event is a clear example of how pushing employees too hard for sales can lead to systemic misconduct, which can cause major disruptions in the economy and damage public trust. It also shows how regulators and Congress play a vital role in holding big banks accountable when they cross ethical lines. The Wells Fargo fake account scandal remains a key lesson in the importance of ethical business practices and proper oversight in the financial world.